For my 401k, I'm sticking to QQQM because I value its combination of high, safe, and dependable dividend growth. But if you prefer a more diversified approach with lower fees, Schg might be the right choice for you if you're looking to build a strong portfolio that grows in value over time while providing consistent income. You might be cautious about the ongoing debate between Schg and QQQM. These two exchange-traded funds or ETFs are often compared, especially for investors interested in fast-growing dividends. In this video, we'll dive deep into why both Schg and QQQM are exceptional choices, but only one emerges as the true king of dividend growth. Now, before we get into the numbers, let's talk about the broader strategy. Growth ETFs are an excellent way to get exposure to some of the most promising companies, especially if you don't want to spend time handpicking individual stocks. These ETFs allow you to instantly diversify your portfolio, which can be crucial when you want a hands-off investment approach. But which one should you choose, Schg or QQQM? Let's start by exploring why Schg is considered one of the best growth ETFs in the market. The Schwab US Large Cap Growth ETF charges an impressively low expense ratio of 0.04%, which is significantly lower than QQQM's 0.15%. Over the years, Schg has gained a strong reputation, even earning a 4-star silver rating from Morningstar. But it's not just about the ratings. Schg's return over the last decade placed it in the top 12% of all large cap growth funds, which is no small feat. The ETF is focused on some of the most profitable companies in the US, and its portfolio includes giants like Alphabet, Amazon, and Tesla. In terms of growth, Morningstar analysts project that Schg could deliver long-term growth of around 13.3% annually. That translates to approximately 13.9% in long-term total returns, which is quite impressive for a fund with an expense ratio this low. Valuation-wise, its price-to-earnings ratio sits at a reasonable 21.5, and when adjusted for cash flow, the number becomes even more appealing at 13.9. So, why might some investors still prefer QQQM? QQQM, the lower-cost version of the well-known QQQ ETF, has a unique advantage when it comes to dividends. While Schg might be exceptional in terms of growth, QQQM excels in dividend dependability. The Nasdaq 100, which QQQM tracks, has shown consistent dividend growth over the past 17 years with an annual compound growth rate of 17.1%. That's nearly double the 8.9% of CAGR seen in the S&P 500 over the same period. If you had invested in QQQ 10 years ago, your yield on cost could now be around 10%, a testament to the power of long-term dividend growth. QQQM also boasts a solid portfolio of companies, though it's more concentrated than Schg. Around 80% of QQQM is made up of big cap tech companies including Apple, Microsoft, and Nvidia. Morningstar projects long-term growth for QQQM to be around 11.8%, slightly below Schg, but still very respectable. What's particularly noteworthy about QQQM is how it performed during tough times. In 2020, during the pandemic, its dividend growth was still positive at 9%, and during the Great Recession, its dividend grew by an astonishing 17%. This level of dependability is hard to beat, even if Schg has outperformed QQQ in total returns over shorter time of period. Now let's dig into the comparisons between the two funds. Schg holds more companies around 250 compared to QQQM's 100. This gives Schg broader exposure, but it also means that QQQM is more concentrated in those high growth tech giants that have been dominating the market. Schg is projected to deliver around 13.8% in long-term returns, while QQQM comes in slightly lower at 12.6%. Both are highly attractive, but which one you choose depends on your investment goals. Schg might be better for those seeking more diversification and broader exposure to growth stocks. QQQM, on the other hand, is ideal for investors prioritizing dependable, fast-growing dividends. From a cost perspective, Schg clearly wins with its razor-thin expense ratio of 0.04% compared to QQQM 0.15%. But When you look at historical performance, QQQ has consistently been in the top 2% of all large cap growth ETFs over the past 15 years. Schg, while impressive, ranks in the top 12%. An area where QQQM shines is its risk-adjusted returns. The Nasdaq 100, which QQQM tracks, has consistently delivered strong returns while maintaining a very low level of volatility. Schg, although slightly more volatile, still offers solid risk-adjusted returns. If you're looking at long-term risk and inflation-adjusted returns, Schg is projected to deliver around 9.1%, while QQQM comes in slightly lower at 7.1%. Dividend growth is another key factor to consider. Schg has shown some variability in its dividend growth, even recording negative growth in several years, including an expected decline of -8% in 2024. QQQM, on the other hand, has only had 1 year of negative dividend growth, and that was back in 2014, when it dipped by just 2%. This makes QQQM a much more reliable choice for income-focused investors. When we compare these two ETFs over a longer period, QQQ has historically outperformed Schg in terms of total returns, especially over the past 15 years. But Schg isn't far behind, and its lower expense ratio could help it close the gap in the coming years. So, what's the bottom line? Both Schg and QQQM are excellent growth ETFs, and either one would make a fine addition to your portfolio. Schg offers broader diversification and a slightly higher long-term growth potential, while QQQM provides more dependable dividend growth and has a track record of outperforming in terms of total returns. For my 401k, I'm sticking with QQQM because I value its combination of high, safe, and dependable dividend growth. But if you prefer a more diversified approach with low fees, Schg might be the right choice for you. In the end, the decision comes down to your personal investment goals. Do you prioritize fast, consistent dividend growth, or do you want broader exposure to growth stocks with a focus on low cost? Whatever you choose, both ETFs have the potential to significantly grow your wealth over the time. That's all for today.